issue. It can be done in the IPO, 3,500. So what? Back to okay, let's start. Just write, check the audio, write in the chat box loud and clear. I'll just show the relationship between stock price and equity capital, that is number of shares. Okay, this is very hidden parameter which many people miss. I shown you Reliance, how Reliance keeps selling the shares to control the price, because when number of shares are increased, this number of share is very important parameter for ratios. Because when we calculate earning per share, EPS, what is the formula? Total profit after tax divided by number of shares. When we talk about book value, it is a net worth. We call this as a total equity divided by number of shares. Even dividend yield, everywhere number of shares will come into picture. Number of shares can be increased by a company by issuing the fresh shares. Issue, it is called as issue. It can be done in the IPO. It can be done in the follow-up offer. It can be done in the right issue. It can be done via private placement. Sometimes it can be done by ESOP, that is for the employees take. So fresh issue increase number of shares. There is one more parameter called as face value, which is nominal price. And when you multiply face value by number of share, it is called as a share capital or equity capital, one and same. So you have to keep eye on equity capital. What is happening with the equity capital? The moment you see the any company, first thing you go and find out uh, what is happening with the equity capital, so that you will not forget when you talk about businesses profit. You will not forget that. So this is a Adani Enterprises. Okay. Now it was 500 rupees in the 2021, and suddenly it becomes 3,500. So what happens when price goes up? Okay, we know that EPS is profit after tax and number of shares, and PE ratio is price of the shares divided by EPS. Correct. So if EPS remains the same, that means profit does not change every day. Even shares do not change. EPS remains the same and price keep on increasing. P ratio goes up. Okay. So let's check P ratio of Reliance. It went 455. So whenever the P ratio goes up, valuation becomes hyper value or over value, and the Hindenburg like people get attracted that this is overvalued. That means something is wrong. So whenever overvalued is there, correction is inevitable. So the correction of Hindenburg was not because of story or any manipulation. It was because purely the valuation game. And even Hindenburg report, those who have read, it said clearly, forget my analysis, entire analysis, but even based on the valuation, this valuation is not sustainable. That was the key story. Rest everything was the not the relevant. What was the relevant was the PE ratio. Why PE ratio goes up? Because EPS remains the same, price is going up. How to reduce PE ratio is very simple. Increase the number of shares. If price is going up, earning per share is a pot. Profit cannot increase immediately. Number of shares. If Adani has sold fresh issued shares at this point of time, P will not go high because EPS is automatically going to get reduced because increased number of shares. So EPS can be reduced by increasing the number of shares as well. So sometimes you see that EPS, okay, this is EPS. So EPS can be happen by two ways. Either PAT is going down or number of shares also going up. So just EPS P ratio पे नहीं जाने उसके पीछे भी जाने What are the reasons of going EPS going down? There can be two reasons, because it is a ratio. Either profit is going down or shares are increasing. If Adani has sold a lot of shares here, the P ratio should not go up, because the share will be controlled that P ratio. But now you say, if this is the scenario, then why this Adani people did not do it? Well, they started doing after the scenario, you see that, but not that much aggressively. You see the since 2014 to 2022, little Hindenburg's came into picture. The equity capital remained the same. No fresh shares were sold. But thereafter, they have started, थोड़े होशियार हो गए जो धीरू भाई बहुत पहले समझ गए थे. Now they are started selling the shares, but still not aggressive, because uh, when you issue the fresh shares, the promoters holding, so the third dot you have to connect is promoter shareholding. Okay, it is reduced when you uh, sell the shares. Promoter shareholding goes down. So Adani, as of now, they are holding uh, big chunk of shares, 73. They don't want to lose control, and now this is remaining FII. I think this is pseudo FII. That means Indian money is going out and they are coming back into India. So this is very controlled business. Public shareholding is hardly 7-6%. Why Adani recovered Hindenburg attack is this. If public shareholding is huge, company cannot recover back. If you see the Reliance communication, if public shareholding is huge, it cannot recover. But this Adani is a controlled. Public shareholding is very minimal, because those strong players are not selling, so eventually the supply is limited. Where is that? So the public shareholding is 93%. Even it when it was down, it was significantly low. So scenario here, you have to understand company continuously engage in three type of activities. One is real business. Second is doing equity raising business, collecting the money. That is called as financing activities, and the borrowing. Okay, so Adani's main business, the main money raising was raising the loan. Okay, you see the loan borrowing consistently, the borrowing is very high. If you see the balance sheet, so what we check in the balance sheet is always equity. First line is equity capital. What you see, that equity capital is very simple, number of shares into face value. Where will you get the face value? It is available on the annual report. You can search on Google anywhere, or in the screener also there is a face value. Where is it? If it is not there, I can show here. Face value. See, this face value is 1 rupees. Okay, so face value is 1 rupees. Then you can see that, tell me the number of shares of Adani. ये Adani है क्या? हाँ. Number of shares. If face value is 1, number of shares are 110 crore. You have seen in the Reliance, where it was 294 crores, and it becomes 4 times in last 10 years. But in this case, they have not increased, minimal increase, and that too because of this Hindenburg, and they slowly is realizing that they have to give up. But then how Adani was growing, see the borrowing. So it was borrowing consistently, and they have huge borrowing. Okay, huge borrowing, almost 1.01, more than 1 lakh crore. So Adani was not raising money from the uh, shareholder. It was not raising from the bondholder or lenders. Third is a customer. So you will remember there are four ways money can come in. Either shareholder can put money, or bondholder, or customer, or maybe asset selling. But that is not the main for the business. These are the three main things money can come in. For Zomato, shareholder. For Adani, uh, bondholders. And for TCS, customers. You remember this pattern, three patterns. Reliance is in between. Reliance सब कुछ करता है. Main business is shareholders money. Adani क्या होगा इसको? Bondholders or loan. TCS, customers. TCS does not sell the fresh shares. It does not take the loan. Then how it is growing? By customers. So three ways, three people sponsor money to the company: shareholder, bondholder, and customer. Which type of company indulging it? You have to understand. Ideally is this. This is not something. This looks like a Ponzi scheme. You are taking money and growing. What is the point? Ideal money should come from the customer. Now you may say that here debt to equity ratio is very high. Equity here, this is you calculate from here as well. This is the equity reserve, and this is a debt. D ratio is very high. Debt is high, but this Adani business is completely different. I'll explain why it is high. Because in a balance sheet, this is a balance sheet, equity component, and asset side. Asset side, Adani has a lot of physical asset, especially land. Now, land is mentioned at historical cost. Some maybe he might got 1 rupee per hectare or even smaller. That is the reason the value of asset is low. Okay, and this is a debt. Okay, value so asset is shown less. That is the reason equity value is shown less. That might be the reason D ratio of Adani is high. In a balance sheet preparation, accounting principle says that while preparing balance sheet, uh, you have to take the you can take three types of valuation. One is historical cost. Second is market cost. Let's say for the especially for the financial instrument, it is called as fair value or market cost. And third is a depreciated cost. Land does not depreciate land value. So companies show at historical cost. So if you see the Godrej, their land might be 100 rupees per acre, 100 rupees. Maybe 50, 60 years ago, they bought in 100 rupees. Now that value might be 10,000 crore today's market, but they will show at cost. Tata Steel, they have thousands of acre land, but their asset is very small because they show historical cost. That is an accounting standard. Depreciating asset are the machines whose value goes down. So if you have a lot of depreciating asset, that's the reason asset value goes down. And only financial asset which are fair value, they can show uh, rise. So the companies which have the land and depreciating asset, their asset value is less. That's why equity amount is less. So in comparison to debt, it looks like it is very debt. But if you try to sell that uh, entire value, it will be much more. It is called as hidden value. Okay. So D is not the only criteria to decide whether it is bad or not. You have to see the what E represent asset. What is assets are there? We are discussing how to understand the balance sheet. Go and find out the asset side. Okay, two sides. One is liability side and less asset side. And find out the fixed asset. So you see that this company has a lot of assets which are fixed asset. Land, building, jewelry, sea. So these assets are in account, books of account are valued less. You can see that this land, this 2000, 2200, and even land price is hardly change. अभी land price तो double होगा ना, triple होगा, but land they are shown at historical cost. So asset price is not going up. Buildings, okay, now their price is going up. That is because of new. They might be buying new building. Okay, but building is also depreciating asset. Plant is also depreciating asset. So on asset you divide asset of three types. One is depreciating asset. This will be useful in your medical hospital as well. Understand the assets. Appreciating asset and historical. Something happened. I just. So in a valuation or when you create account statement, asset can be placed at T value at three types. One is historical, no appreciation, no depreciation, same value. Here it will be at market price, fair value. Suppose if any company has depreciating asset and historical, its asset will not go up. It means equity will also not go up because asset represent equity. How? This is equation. Equity. Equity is just entry. This is a debt. And this entire thing is asset. If asset is not going up, equity cannot go. Now debt is number which you have to pay. Every year you are showing depreciation, asset value is going down, automatically E value is going down. Debt is a debt, so it cannot go down unless you repay. That is the reason sometimes debt equity ratio can be misleading. To find out whether this high D ratio can be justified, you have to see the asset column, what is there. Okay. In a balance sheet, so reading the balance sheet, it is the snapshot of asset and liability. It is written like this. Left side, right side, usually right hand side. And asset, they are called as non-current asset, current asset. Here, equity. So equity is nothing but the residual value after subtracting debt. So this is non-current liability and current liability. This three heading. And if you do the total, this will be, let's say, 100 rupees total. Addition, it will be 100 rupees. So these two will be balanced. That is also called as balance sheet. Asset and liability should be balanced. Equation of accounting is asset minus liability equal to equity. Asset minus liability. Liability will be this two. So this is a master equation. Your accounting is depend upon this. Ali, asset minus liability is equal to equity. Equity is nothing but the residue. Now this liability is company has to pay money to lenders or creditors. So what are the possible ways to increase the equity? Can you write down? Common sense. Okay. One is increasing the asset on reducing the liability. That's how equity can increase. What are the causes of reducing equity? Reducing the asset value and increasing the liability. Okay. So when company has a lot of depreciating assets, its equity value goes down eventually, but those assets might be useful later on. So in a balance sheet, what you see is the equity and borrowing or debt. And you take the, let's take the ratios of balance sheet only. From the balance sheet, we take the debt equity ratio. How we take at WealthCon, we take non-current liability divided by equity. D ratio. Another ratio is AE ratio, that is total asset divided by equity. Total asset divided by equity. This is called as leverage ratio, and this is loan ratio. These two ratios suggest debt component, how much debt and how much own money is there. D ratio and AE ratio. Another ratio is current ratio. Current ratio. It is very simple. Current asset divided by current liability. One more ratio is a quick ratio. It is similar to current ratio, but numerator is little different. It is current asset minus inventory. Inventory includes raw material as well. That's why it may not be right to consider current ratio. That's why people came with the inventory and current liability. So if you remember this and use this, this is also, it is not required, but since this is a basic of QR, so you can understand this as well. Okay, from balance sheet, which ratios we can derive? One is DE ratio, AE ratio. In a books, whatever it is given at WealthCon, we consider non-current liability as a numerator. Equity, current ratio, quick ratio. Okay, these four ratios we derived from the balance sheet. One more thing is working capital. Working capital is subtraction of current asset minus current liability. If you remember, current ratio was what? Current asset divided by current liability. Here it was ratio and here it is liability. So working capital is the difference between current asset and current liability. Current ratio is the difference between current asset and current liability. Okay. Current asset, current liability, I explained in a video what is the definition. So these are the ratios we take. I'll explain its importance as well once we explain the calculation. Then from the profit loss statement, at the top line, you remember this. सबसे होता है ऊपर sales or revenue. Sometimes people say revenue, some people say income, sometimes people say sales. It's more on same. Thereafter, cost and then EBITDA. Earning before interest, dividend, amortization and tax. ठीक है? EBITDA. EBITDA. Usually it should be EBITDA, but they say EBITDA, but it is same. Just for the simplicity, they say TA, but it is EBITDA. So EBITDA. Then amortization is like a depreciation of intangible asset. Depreciation is a depreciation of the tangible asset. EBITDA, EBITDA only was इसे कि क्या बोला है? Sales. I hope you are writing. Not writing, then write. Then EBIT, earning before interest and tax. Then EBT, earning before tax. And last is earning or profit after tax. Okay, so let's subtract one by one. From sales, expenses, operating expenses, from sales, if you subtract operating expenses, what you get is the earning before interest, dividend, and tax and amortization. If you subtract depreciation from this value, you get earning before interest, tax. If you subtract interest from here, you get earning before tax. If you subtract tax from here, you get PAT. Okay. Why this is important? Each line has its own relevance. Okay. This is depreciation. So why it is important? We have seen that company growth, mature, and decline. Right? So when company is beginning, it may not be in a profitable at the beginning. Okay. It may not be profitable. First step is company start getting EBITDA positive. Sometime be EBIT, this is also called as operating profit. EBIT is called as operating profit. Write down here. EBIT is operating profit. So when company is growing, first thing positive comes is the EBITDA. This might be negative. Next level, operating profit become positive. Thereafter, earning before interest tax positive. And lastly, thereafter PAT. And thereafter companies start giving dividend. And before that tax. So in this cycle, mature companies give the dividend, they have the PAT. Growth companies may not be positive PAT, may not give dividend, but their EBITDA should be positive, operating profit should be positive. If any company is not showing EBITDA positive, that means they are just burning cash, taking money from the investor and burning. For example, Baiju, and there are some companies as well. So those are startups. So first step that when you invest, uh, that EBITDA must be positive, because if that is not the positive, that means it is not, we say, appropriate business, at least EBITDA should be positive. As you go on the next step, uh, operating profit, that is EBIT now, operating profit positive. So EBITDA positive, operating profit positive. Then what is the next? Can you write chat box? That is EBIT. Or EBIT is operating profit, which have subtracted operating expenses as well depreciation. Then earning before tax and PAT. We usually do not invest into the company which are not making a profit. So we are somewhere here. If you are aggressive, we will not recommend. If you are aggressive, so even company is making losses, but if you focus on operating profit, that level, if operating profit is there, uh, that is also people, the people who are aggressive investor and they want to invest into the startup and fast growing company, they invest in a, even if there is a EBITDA is positive. But be aware, these rules will be applicable only in the new growing industry. The company which are already 30 years old, and if you say that it is not making profit, it is not ideal. So rule is that if you are an aggressive investor and investing in a new company, growing company, even if it is not paying dividend, because though it is a growing company, sometime it is not making profit. uh, let's show a Naika का example दिखाते हैं. If company is paying dividend, means what the, in which stage of company is this? GMD, growth mature. So this is the company. You see that operating profit. Here EBITDA is not mentioned. They have compressed. They are not going to a granular level. So for early investor, operating profit is enough, and profit after tax is enough. Okay, don't go into the too many complicated. So operating profit means the depreciation is also, operating expense is also subtracted, and depreciation is also subtracted, and this is EBIT, earning before interest tax. Tax is subtracted later on. Okay, now see it is shown here, but anyway, it is their format. But conceptually you should remember that operating profit exclude the depreciation as well. Okay, go and see the profit before tax. Okay, see this is, initially it was making losses. Now it is making profit. Net profit you can see here, loss. PBT is also loss. Operating profit here, you see I said operating profit become positive before net profit start become positive. So the operating profit has become positive before the net, this is PAT, it has become positive. So if company is in a new industry, uh, this logic of investing based on the operating profit and EBIT is okay. But the company is in an old industry, never invest into the loss making company. So let's write a rule here. If industry is already mature, there are many players, only profit making companies. If you are Again, little conservative, only dividend paying companies. So you are focusing on the mature companies here. Even mature companies also give a significant wealth. It's not that mature company is not good, but growth companies have more potential, but that is also aggressive or risky as well. So let's understand the mature company first. Okay. So what are the ratios from the profit loss statement? Ratios calculation is operating profit margin is operating profit divided by sales is the ratio multiply by 100. Then NPM, net profit margin. People take EBITDA margin, etc. But you go later on, understand two main ratios. Additional information you can fill gap later on. Is the PAT, profit after tax and sales into 100. Okay. So these two ratios derived from the uh, profit loss statement. Then there are ratios which combine profit loss statement and balance sheet. What are those? ROCE, return on equity, is equal to PAT, profit after tax, which will come from the profit loss statement, and equity from the balance sheet, and then multiply by 100. Then there is ROCE as well, return on capital employed. Numerator remains the same, PAT. Denominator is equity, total equity. It is not equity capital, entire equity, which includes other equity as well. It is net worth basically, and non-current liability into 100. Books might give different, but use this at wealth call. And ROA, so PAT, that is profit after tax, divided by total asset into 100. So these ratios will be applicable only to the company which make the profit. That means growing, little late growing and mature. If company is not making profit, then these ratios are not useful. So we'll focus more on these ratios where profitable companies. So company you divide into profitable company and not profitable company. Okay. So profitable and not profitable. Not profitable might be growing or dying as well. So that's the reason loss making company can be either growing or dying. Both are coming down. So you have to differentiate between growing and dying based on the history. How many years company exists and in which industry company exists. If any IT company is making losses as of now is not something which is industry is already mature. If any bank is losing money where other banks are making profit, it's not the growing company, it is a dying company. Okay, so let's go again. Okay, 4P analysis. In 4P analysis, what we do is the quantitative analysis, different business metrics, shareholding patterns, financial data, profitability, what we are discussing, valuation, PS ratio, PB ratio, and these are the qualitative information we look for. Okay, go here. So I explained the calculation of growth rates. This is margins. Some people say gross profit margin, EBITDA margin, OPM, NPM. I explained these two. These are more or less same. It is used in new companies. Then ROA, I explained this. And one important is this DuPont analysis. Sometime you may say that return on equity is very high or good, but it can be misleading information because ROE can be increased by, uh, if you split this, it's a net profit, that is PAT, divided by sales into sales into asset. Sales into total asset. It is called as asset turnover ratio, and RO asset. I recommend you to read about this DuPont analysis and equity. So this is a leverage ratio, and this is ROE. Now this ROE can be increased by multiple ways. For example, if any company does lot of turnover or do business, that can increase ROE. It can be increased because of profit margin is high, or sometime company is taking high loan on leverage. AE ratio is suggest leverage because of it has taken the debt. That's why ROE is high. So just ROE is not the right parameter. You have to compare with ROCE and ROA as well. Okay, because if ROE is higher than the ROCE, that means company has taken the loan. Okay, so this is a DuPont analysis. These are the ratio. This is quick ratio and current ratio. Now let's go to the actual scenarios and analysis of the company. So this was the calculation and the ratios. In a bank's, what I forgot here, DE ratio is not relevant. Because company business is taking the loan. So in a bank, what are the ratios irrelevant is the uh, net, not GPA and NPA. It is non-performing asset. Non-performing asset, that means defaulter of loan. So if NPA is more than 3%, etc., it is not, it is a risky. Then loan to equity ratio, then capital adequacy ratio. These are uh, considered for the analysis. Now in a bank, what you can do is this, A ratio is also relevant. That is asset divided by equity. How much is the leverage of the company? And loan to equity ratio is how much is what's own capital and given as a loan. It is inverse of adequate capital adequacy ratio. It means if bank gives 100 rupees loan, how much is its own equity? That is loan to equity. And if you take the inverse, it is a capital adequacy ratio. In India, usually it is capital adequacy ratio is 15%. So how much will be the loan to equity ratio? Can you calculate and tell? It is inverse. That means loan to equity ratio may be 6 or 7. Okay, how much loan and how much is own equity. Okay, you know one interesting thing I will explain about the banks, and it is understood by very few number of people how banks work. Most of the people believe that bank take the deposit from the investor and give loan to the lender. This is the common understanding. What if I say that this is not required? In reality, bank give the loan and create a deposit. Means if you go and ask bank 100 rupees, in bank's balance sheet, it will show 100 rupees on asset side and 100 rupees on liability side. That means loan itself is a deposit. दिस फैसिलिटी दिस ये गॉड गिवन फैसिलिटी हमको नहीं दिया है, सिर्फ बैंक को होता है, आरबीआई भी यही करता है. सो दिस इज अ बैलेंस शीट. This interesting phenomena I learned when I was studying for MA Economics, and it is modern monetary theory. So if you uh, take the loan, it gives 100 rupees to the loan borrower, and it create another entry on balance sheet. So this is a liability and this is asset to the bank. So this is a loan amount and this is a deposit amount, account entry. Now, if I buy, let's say Amit buy take loan of 100 rupees. Now this deposit, which is shown in the name of Amit, and he give this rupees to someone else, let's say Rupesh, and his account is in ICICI Bank. This is an HDFC Bank. So deposit will move to ICICI Bank, but loan stay with the HDFC Bank. But ICICI will say, but why should I consider this as a deposit? On the background, under the reserve section, the bank will transfer deposit to the another bank. So there are two entries simultaneously going on, interbank entries. Because this money which moves within a bank is nothing but the only account entries. So deposit keeps on moving and loans stay there. So it is a misunderstanding that bank need money to this. But then why banks require money? Bank require money because to give 100 rupees deposit, bank need to buy reserve. They have to keep 4 rupees with the reserve, 4% with the reserve, and additional 18% government security. That means to give 100 rupees loan, they have to keep 22 rupees as a reserve. That is why they need money. To give the loan, they don't need money. To keep a reserve, they need a money. And the constraint, another constraint is capital adequacy ratio. RBI says that if your capital is 100 rupees, you cannot give loan more than 800 rupees. You cannot have the 5x, 4x leverage. Okay. Banks is a very interesting entity. We'll see some other day or kabhi aaya the Tuesday meet mein. Let's go to the real scenarios and do the analysis of each company. कोई भी कंपनी बोलते BSc. Okay, BSc is, so how do you analyze company analysis? First thing, you go and ask read the story क्या करती है. So you have to find it out the stories and then data. Stories, what they are selling. First is whether it is manufacturing or service or middleman. Okay, so take a pen and paper and classify. Tell me which is the company, either manufacturing, service, or middleman. That is A. That is middleman may be either just aggregator agency or bank. So here BSc is service. It provides service. It does not manufacture. And then you can read the stories and go and find out the segments as well. Product segment. When you click on the product segment, you get what company sells. Okay. there are, if you check the Reliance, there can be multiple segment, or if this company, if see, this Nykaa has a different segments. Okay, Reliance का क्या है? So you are first finding out what company is selling and what are the product service that will give idea what you expect in the balance sheet and this. So this is the Reliance uh, Industries. Okay, segments. This is oil to manufacture. So this is the they are selling the goods. Then retail. So they are acting as a trading company as well, traders. Then digital service. So Reliance is in all type of business, goods, service. So that's why it is a complex. I will show Asian Paints. Go and find the segments. क्या क्या sell कर रहे हैं? Product segments. Okay. So there is only one segment here of goods and services. Let's take a Tata Motor. कहाँ गया टाटा मोटर? हाँ, टाटा मोटर का नहीं है। टाटा स्टील का क्या है? Product segment. So you see with what products services they are selling. Okay. Next, accordingly, you will be expecting if it is a service company, then you when you check the balance sheet, what can you see that it will not have too many fixed asset. So this is a balance sheet of BSC. Uh, on balance sheet, what you are saying that how much equity, okay, equity capital. This is number of shares and face value, whether they are selling or not. Now, selling share is not bad. Okay, selling share is not bad, provided that money is used for productive purpose and sales is rising. That means products are rising. That this money should be in synchronous with the this line. If company is selling equity and taking money from the investor, where that money is going on? Obviously, it has to deploy in the business. How you find that business is growing on? This line has to grow up. So if equity is rising, that means they are taking money from shareholder. This should also go up. Otherwise, that is a Ponzi business. This is the sell line or customer's money. Same relation is applicable to the borrow loan as well. If company is taking increasing loan year on year, that means bondholders, sales should go up. So if you see the discrepancy, that if debt is going up, equity going up, and sales is going down, what is that? What is that? If debt is going up year on year, equity is going up, but sales is going down. It is the sign of declining and death. Okay. The rising equity and rising debt has to be justified by rising the sales. If it is not, it is a Ponzi business or dying business. Okay, so you'll see the equity on the profit loss, sales on the profit loss, and equity on the balance sheet. If you know the MPTDS criteria, we have sales because sales justify the loan as well as equity. Okay. Second thing on the balance sheet is the borrowing. Whether borrowing is increasing or not, whether borrowing यहाँ पे तो है ही नहीं, but इसका होगा, अडानी का होगा. और रिलायंस का भी होगा। See, the sales is definitely growing, and now we can say double. Initially it was 433, now we can see 962 equity. So here we are comparing the trend overall trend. This is equity and borrowing. Okay, so it is rising, borrowing is rising, even equity capital is rising. But what is the justification for this rise? Is this sales. So these three lines should be seen as together: sales line, equity, and uh, borrowing. Because company can raise money from three sources. One is customer, that will come from the sales, other is coming from the investor shareholder, and other coming from the lenders. So these three should be always go up to justify the uh, borrowing and equity. Okay, let's go to the again balance sheet. What you see on a balance sheet again is the whether fixed assets are there or not, land, building. So even if D ratio, debt to equity ratio, is high, so this is a debt and this is equity. Ideally, total equity is considered this, but this is very small amount. Let's take this. This is a total equity and this is a debt. So take the debt D ratio. You can see that how much will the D ratio? You can take this simple number 374, approximately 829. So you can do visual calculation as well. Okay, you this number is very small, so you can ignore it. Just take this ratio. 3/8 भी करेंगे तो भी हो जाएगा. 3/8 कितना हो गया? D ratio 3/8 0.4 के आसपास, 0.4 के आसपास होगा. 0.4. Okay, so that is manageable. One more thing you can again see that debt total value is also reducing since last 3 years. Okay, so here it went up to 4.5 lakh crore, right? This is in lakh crore, this is in crores, so lakh crore. Now it has reduced. So initially this was because of geo and all things, now it is reducing. So Reliance is reducing the debt since last 3 years. Okay? And this reserve is the basically equity or net worth. Okay, if you can add up these two things, this is a net worth. So net worth is also definitely going up. Okay, you can see this. Net worth has multiplied by 4 times since 10 years. Okay? 195 to 829. So it is 4 multiplied by 4. So this is a net worth. Okay, it's a reserve, but you can say it's the main component of net worth. So reserve is the part of equity or net worth. This is a borrowing. You see that other component as well in this balance sheet. So you can take the D ratio guess from the balance sheet. Now let's go to the profit loss statement. Okay. So you can see the operating profit margin. They already calculated for this operating profit margin. For the growing company, initially operating profit margin should go up. This margin. This is one important parameters. Initially, growing company has very less profit, but margins slightly go up, and then stabilize, and then slightly go down. Okay. So if operating profit margin is growing, even net profit margin is growing, that is a growing company. Another difference is growing and dying company is this. So this is an ICA. Initially, see that operating profit margin was minus 2, 5, 6, 4. So it is up to 7. So initially, that is what I am saying. It is not in linear function, but you get the idea that initially operating profit was minus, then 2, and now it has gone up to 6. Maybe it will grow, but thereafter it may not. But at least you can get the idea of whether it is companies dying or growing based on the operating profit margin. If you want to check immediately, here is the operating profit margin. Deselect this. Okay. So this yellow line is the operating profit margin. For the growing company, it slide it is slightly growing or stable. It will never be declining. The signs of declining companies reducing the margin. In fact, first sign is seen in the reducing the margin when companies start declining. Loss happens afterwards. So dying company, sales is going down. Before sales is going down, the OPM start going down. Margins compression happens before sales go down. So margin compression, it because of competition or cost. If operating profit margin is going down, that is a not good sign. But just one parameter will not give everything. You have to see entire picture. Okay, uh, that is operating profit margin on the profit loss statement. What else you see that whether company, how much is the interest component as compared to operating profit margin. You can see that interest component, it represents the dividend. It should not be too much, otherwise it is not healthy. You see the profit before tax, after tax, then EPS, earning per share. This is ready-madely given. You can use this in a PE ratio. So on the, can you calculate the net profit margin of this company? Operating profit margin is already given. So you calculate here, net profit, you can take this 33 and sales. Net profit margin, it is called as NPM, is equal to net profit divided by sales multiply by 100. नेट प्रॉफिट मार्जिन एक और हॉस्पिटल का निकालते हैं. हैव यू कैलकुलेटेड प्रॉफिट मार्जिन ऑफ योर हॉस्पिटल? कभी नहीं किया तो आज जाके करो कितना ऑपरेटिंग प्रॉफिट मार्जिन है या तो नेट प्रॉफिट मार्जिन. लेट्स टेक द अपोलो हॉस्पिटल. कौन सा हॉस्पिटल है? अपोलो हॉस्पिटल का ऑपरेटिंग प्रॉफिट मार्जिन देखते हैं. वी आर डिस्कसिंग द प्रॉफिट लॉस स्टेटमेंट. ओके, ऑपरेटिंग प्रॉफिट मार्जिन इज 14% एंड नेट प्रॉफिट किसी ने कैलकुलेट किया क्या? देखता हूँ. 1.4. So you can see that very low margin in that is a e-commerce business. E-commerce business, it is they're taking hardly 2-3% commission. So margin has to be very less. What they calculate that how much they value sold as compared to, but that is maximum part goes to the good suppliers. So that's why e-commerce margins are very less. Even DMart margin is 6 to 7%. So let's say hospital, calculate the net profit margin of 2025. This is a net profit. This is the sales. Net profit margin. You can calculate operating profit margin as well. This is operating profit margin. So calculate net profit margin. What does net profit margin say? That if you collect 100 rupees from the patient, how much is remaining in your hand? Rest will go outside. So कितना आया नेट प्रॉफिट मार्जिन? 6.9. it means what does that mean? It means Apollo hospital collect 100 rupees bill from the patient, and what remains is the 6.9 approximately 7%. Let's take 7%. Rest 93 rupees goes to the middle line. Middle line includes everyone. Someone is saying it is lying. I don't know what is lying. Okay. So this is the hospital, Apollo Hospital. Okay. Uh, you can calculate your NPM operating profit margin in your hospital. What you collect, what you do, you collect entire revenue from the patients in 1 year. Let's say it is 3 crores. I'll write 300. Okay. Then you take all the expenses. Don't include interest here. Interest of a loan, then it becomes operating expenses, operating profit. Suppose these expenses are uh, 2 2 crore. So 1 crore will be the operating expenses. And if you subtract another interest, then it will be profit before tax. Then again subtract the tax, and then what remains is the net profit. So if you collect 3 crores from the patients, how much you take home? Let's say 50 lakhs rupees. Then you divide 50 lakhs by 300 rupees. You take the margins. Okay. So what we discuss is the how to find the ratios on the balance sheet. Okay. All right. We'll take a 3-4 minutes break, and then we'll take resume again.
Thank you, sir. We'll take a 4 minutes break. Thank you, sir. We'll take 4 minutes break and we'll be back by 12:19.